Hang on, let me pause. Hi, everyone. This is Gary Wilson. Welcome to this week's live Path to Prosperity webinar. Most of us are global investor agents, and we always have students tap into who are not on the team, and that's okay. Even other students from investor programs for flipping, buying rentals, and wholesaling. So David Edwards, fellow team member, one of the very first members of the team, bringing in his personal tax accountant, Neal McSpadden. So I'll let Dave introduce Neal. Neal's in Atlanta right now. David's in the Panhandle of Florida, and I'm in beautiful Beaver County, Pennsylvania. so tonight's so we're going to go. Neal's going to present tonight, go over some tips and pointers on tax accounting, and so you guys make sure you ask questions, because we normally don't have an expert like this online, and here's your opportunity to ask all the questions you want. So without further ado, David Edwards, go ahead and take it away, brother.
Sure. Hey, good evening, everybody. I've had the pleasure of knowing Neal now for, God, what, Neal, 6 years probably?
It's around there, yeah.
Yeah, about 6 years. And through some of the other online marketing and things that I've done in the past. And, over my 35-year business career, I think many of you know I started out as a real estate appraiser, and I used to have this phenomenal tax guy. And to me, a phenomenal tax person is someone who gets it, someone who you can ask questions of, you can discuss your business with, strategies, how do I get structured properly? I'm thinking of doing this. How am I going to get affected if I do that from a tax perspective? If I want to, my goal is to be here in 5 years. What should I do to be able to structure myself properly? And unfortunately, that gentleman passed away, and the next guy that he brought in was, he was a rocket scientist, literally, and it was kind of difficult to communicate with him. So when Neal and I met and we started talking, and I had him do my taxes, it was like, thank God, I finally have somebody again that, I can discuss with. And one of the things that I love about Neal is when you ask him a question, usually his response 75% of the time is going to be, well, it depends. What are we trying to accomplish here? Because obviously with the tax code being the way it is, there's more than one way to skin a cat. So Neal's phenomenal. He saved me a ton of money. I could give a list of people that I've referred to him that have always been super happy, and I've seen him do amazing things. So, and Neal has launched his new business in the last, 6 or 8 months?
Yeah, full time. It's been about
Yeah,
8 months.
Yeah. So I'll let him give you a little bit of his background, and make sure you ask your questions. Neal's helping me with figuring out how to structure things with my LLCs here in Florida, and he's just a wealth of knowledge. So with that, Neal McSpadden.
All right. Thank you very much. Thanks for the intro. Thank you all for having me. That's this is fun. I am a tax guy, but I have a love of real estate. I've been in, I actually got an appraiser's license back in like 2006, something like that. And I've been investing in and out of real estate over the years. Let's see. Can I share my screen? Oh, it says host disabled. I got a couple things to show you guys. I think Gary has to do it, but so yeah.
Can you see the green share screen button?
I can see it. It says host has disabled screen sharing.
Just 1 second.
Yeah, under the security tab.
Okay, hang on just 1 second here. Sorry about that. I thought that was can make co-host.
Yeah, I've never actually seen Zoom doing a webinar format like this before. It's always been just group meetings that I've seen.
Okay. There we go.
There we go. All right. So, Beverly had asked me to talk, give a topic, and I came up with the top 3 IRS tax traps for real estate agents. So I'm going to go through a couple things here, 3 things specifically. And David is stole a little bit of my thunder with the it depends, but that's all right. So I'm going to go through these 3 things. and we're going to talk about, why there are issues, especially for real estate agents, and then possibly, what to do about them. But whenever I give these kinds of talks, it's always, people have questions because your tax situation is individual to you. So my only request really is that, have your questions, but just let's wait till the end a little bit, and then I've timed things so that we should have plenty of time to get to everybody's questions. But the answer is always it depends. uh, so yeah, Tax Sherpa. Over the years, I've been in the business for about a decade. Filed about 40,000 tax returns, about 250 million in tax payments contained in that 40,000 returns, and roughly $2 billion of client earnings contained in there. So, I do a lot. I came up, this is about me. I think I'm actually wearing the same shirt as I am in this picture, but so
Good
I
looking
can,
shirt.
yeah, when I find things I like, I just buy a bunch of them. It simplifies. But so I was trained in very old school kind of Wall Street tax attorney in a sort of apprenticeship sort of format. And if you've ever sold an index option and you had 60/40 long-term capital gains treatment, that was my mentor who was part of how that all happened. 40,000 tax returns, like I said. Shout out David Edwards for bringing me into this group. I really appreciate. Always love talking about taxes, which people think I'm insane, but it's I come at it from the government's going to do what they're going to do, but I want me, I want you, I want everybody to keep their money in their pockets, and rather than handing it over, all within the guidelines and all that kind of stuff. As far as tax traps, so realtors specifically are about 10 times more likely to be audited by the IRS than other average professions, and we're going to get into why that is exactly. They're also overpaying. I've dealt with, or I've had clients, hundreds of realtors, and on average, we came up with 4,507, overpaying compared to what they, could be doing or should be doing if they were set up properly. And then, a new tax trap is that COVID has fundamentally changed how people work. And there's both opportunities with that, and there's also, potential pitfalls with that. So this is what the IRS calls the tax gap. So this is for tax years 2011 to 2013, because it's based on audits, and it takes them a couple of years to get around to auditing, and then they have a couple of years to resolve all that. Basically, what it's saying is that the IRS thinks that in these years, people owed $2.7 billion of taxes, but they only collected $2.2 billion. And the rest is what they call the tax gap. And in this graph, they break it down into a couple different pieces. But the biggest part by far is underreporting of individual income tax. Corporate income tax has 37, these are in billions. Employment tax is 69 billion. State tax is 1 billion. That's if you die and you have an estate greater than the threshold, which is now about $11 million. So 245 billion of the total is just underreporting of individual income tax. So that's the biggest chunk. That's where they focus the most. And you can see that the biggest chunk of that is, actually, I don't know, it might be kind of small on your screen, but this block right here, business income is 110 billion of the 245. So that is the thing to keep in mind. So tax trap number one, Schedule C. So if we go back, Schedule C is business income on the individual filing. So if you have one of these on your tax return, that automatically increases your risk of audit. And it's about 10 times. And this could be a sole proprietorship, could be a single member LLC, depending on how you have it set up. Most realtors are set up as either just sole prop or a single member LLC, and they are filing Schedule Cs. And we've seen this, hundreds of times. It's the highest audit risk because it's the most underreported, and it's the easiest win for the IRS. And the reason it's the easiest win for the IRS is because it's always about the paperwork. The IRS never gets people on, it's like, oh, you just made up this thing, or, oh, you did this thing and that's against the rules. It's always just, they send what's called a correspondence audit, which is just a letter in the mail. And they say, show us your documentation, show us your substantiation for whatever it is, any kind of expense. And most people can't do it. So it's an automatic win for the IRS. And the Trump tax reform, TICJA, Tax Cut and Jobs Act, which was that 2018 change of everything. One of the effects of that is that they got rid of a whole bunch of stuff on the individual 1040 returns. So they used to have moving expenses. That's no longer a thing. They used to have unreimbursed employee expenses. That's no longer a thing. They used to have casualty losses. That's really no longer a thing. So all these other things got wiped out of the tax returns, and those were all things that the IRS was auditing. And different years they focus on different things. Some years they'll focus on medical expenses, and 2016 they focused a lot on those unreimbursed employee expenses. But now they have less to look at, so they're focusing more and more on the Schedule Cs. Now, on top of that, if you have kids and it affects your tax credits for the kids with either the child tax credit, the additional child tax credit, or the earned income credit, that is a huge area of focus, because that's the government actually sending out money that they were never paid in the first place. So, just massive area for the IRS. And again, it's literally 10 times, and you can see the 10 times here. Business income 110, and corporations, like small corporations, is 11. It's 10 to 1, and that's why your audit risk is so high. So number 2, which I think is going to be a huge thing this year with COVID, is the home office deduction. So let me see if I can bring up the chat here. Let's see. Where's my chat? I don't know if I can see it with the screen sharing, but how many people across the country, we're working in an office, we're doing whatever, and now they're working from home. It's millions and millions of people, and they're going to see on their tax returns this line saying, home office deduction. Mm-hmm. And the way it works, there's 2 ways to calculate a home office deduction.
Hey, by the way, Neal, I think that's probably every single one of us, because some of us already work from home, but a lot of us, our offices were, shut down, and now we're all at EXP, and we don't have offices anyways.
Yeah. So, I mean, me too. So right now, I have this fancy background. I actually have a legit green screen, and I was in an office until March, and then COVID started flaring up, and I was like, you know what? We're just closing it down. And I came home and have been sitting in my basement ever since. So, it's everybody. And when you go through like tax prep software, if you file on TurboTax or one of those, they'll ask you, do you have a home office? And if you go to a tax preparer, they'll ask you, do you have a home office? And millions and millions of people are going to say yes. The problem is that, the way the IRS defines a home office and the way normal people define a home office is not the same thing. Mm-hmm. So there's two ways to calculate a home office and 2 criteria that you need. So the calculation way is that you can take the square footage of your office, and then you take, your bills for utilities and, house payment and all that kind of stuff, and you do a proportion amount, and you come up with some number. That got very complicated. A lot of people messed that up, and they created what's called the safe harbor deduction, which is just $5 a square foot, just flat. So people are going to be filing this, and they're not aware of the requirements. And the requirements are these 2 things right here: the regular and the exclusive. So regular, exclusive. So regular is pretty easy. It's a pretty easy test to satisfy. So regular just means you do it regularly. It could be 5 days a week, could be once a quarter, could be, every second Tuesday, or, every election day, whatever it is. As long as it's regular, you're good. The problem that gets everybody is exclusive. So exclusive means only. It means you do nothing else. And this is where people get into trouble. So there have been a lot of court cases about this. And if you ever want to read tax court memos, you can look up this one, Cook versus Commissioner. This is back in the 90s. And it was some lawyer who was claiming half of his house as his home office. So, went all the way to tax court. And tax court for individuals is almost always lawyers because, they're comfortable in court. They don't have any real costs with, with hiring counsel or anything. So it's like lawyers and then a smattering of tax preparation people who think they're too smart for the IRS. So he was claiming this basically half his house as a home office, and he did have a home office. Clients came to his house, he consulted with them, and all this kind of stuff. But basically, what the court found was that it's like, well, you have this area, and it's it's a sizable area, and you can't prove that you didn't use it for other things, and so they denied his deduction. And it was like a $4,000 deduction, which is not a lot, but it's just the principle of the thing. In when it comes to audits, you're basically guilty until proven innocent. It's not a criminal case, so you don't have the due process kind of protections that you might expect coming from the government. It's preponderance of evidence, and basically the courts have always found that the IRS is right until proven otherwise. So if you have a home office that has other things in it, like a couch or a TV or a chair that's not just you, all of these disqualify you from having a home office. There was a case where, again, it was a lawyer, and he had built a bathroom onto his home office, and it was just his bathroom. We worked there, and he used the bathroom. It was all fine. The IRS challenges it. It goes to court. It comes out in court that during a Christmas party, he let people at the party use his bathroom in his office. They said, "Oh, you violated exclusivity. You're done." So, I mean, if they were to, audit somebody with a home office deduction, it's almost impossible to defend. So you have to keep that in mind. But the opportunity side of this is that, real estate folks, there's a lot of new construction, and with the COVID changes, I've been reading articles at the very least saying that the people or builders are now building in actual home offices. So that could be an actual selling point. Going into the future, saying, "Hey, this is a real home office. This is legitimately something you could work with on your taxes." And if they have any questions, you can just send them to me. I'll explain why that is. But I do think that is a silver lining to the opportunity, rather than taking a bedroom and it's like, oh, there's a bed over here and there's a desk over here, therefore it's okay. But an actual built room is much cleaner to defend rather than a converted room. So number 3, the biggest tax trap for real estate agents is vehicle use. So realtors drive a lot. COVID notwithstanding, it's just ferrying clients around, taking them from this house to that house, or meeting prospects, that whole thing. So the vehicle use is an audit trigger because it's the single largest element of the tax gap. So if we go back into this guy, so this $110 billion, like 50% of that is the tax gap. And I go to IRS seminars every year. This year was online, but normally we go to a conference every year, and they have sessions on the tax gap, and they specifically highlight vehicle use as the thing that they're looking at. And it's tied in with the home office deduction, because the way vehicle usage works is that your commute is not deductible. So I had one client come in. He moved from New York down to Florida, and I was looking at his old returns, and his unreimbursed employee expenses, which is back in the pre-Tax and Jobs Act days, was just crazy. He had like $15,000 of transportation expenses, and he was just a regular office worker. He or his tax person was deducting, driving from New Jersey under the tunnel, paying the tunnel fees, and then into New York every day, which is not kosher. So, your regular commute doesn't work, doesn't count. So what does count is from your regular commute, extra stuff. So, if you're just an office worker, and you go to work, and then your boss says, "Hey, we need you to go pick up this other thing," that mileage works, or that mileage counts, but just home to office doesn't. So with realtors, that's a problem, because if you're working from home, then what part is your commute? And if you have your home office, then you can start your job at your home office, and then you can go. But if your home office gets voided, then all your vehicle mileage get voided because you no longer have a basis for a business mileage. And again, always about the paperwork. So, what you're supposed to do with miles is you're supposed to have a log, you're supposed to have a date, beginning place, ending place, who you met, hopefully why it was a business purpose and all this stuff, which very few people do. There are apps now like Mile IQ, which are pretty good at that, but even so, most people don't use them. So, again, paperwork is what it always comes down to. So those are the problems. Those are the top three problems. There's good things to being a real estate agent as well. So like if you're a real estate agent and investor, as a real estate professional, you get to bypass all the passive activity limits, which is if you make too much money, you can't deduct your real estate. If your tax loss is too great, you're limited to 25,000. So you get to bypass those as a real estate professional. But these three things are serious issues, and we do see lots of audits. So the solution is just don't be an easy target. It's you want to be the professional business person rather than just a tax or a real estate agent. And if you want to read something that's a little bit mind blowing, I think I made a short URL to this testimony. So what happened was that the Congress was upset that the IRS was auditing poor people, and these were people who are getting credits mostly for their children, earned income credit, child tax credit, additional child tax credit, and all that. So the IRS commissioner went before Congress and he gave some testimony, and a good part of it was prepared, so it's all written out. So if you go to this link, you can see the whole thing. But the summary, I think, was right here. So they said, the IRS cannot simply shift examination resources from single issue correspondence audits to more complex, higher income audits because of employee experience and skill set. A GS8, which is a payroll level in the government, a GS8 tax examiner is not trained to conduct a high income, high wealth taxpayer audit. In order to increase parity of numbers of taxpayers audited, the IRS must reallocate high-graded resources from certain issues to high-income, high-wealth taxpayer returns. Further, the rate of attrition is significantly higher among these more experienced examiners. It is also important to maintaining the voluntary compliance level that the IRS has an audit presence across all income groups, including EITC, which is Earned Income Tax Credit. So basically what it's saying is that it's easier to audit, people who are not complicated, and they make more money doing it because personnel costs are lower, and the people who are audited in those groups are less likely to defend themselves and suck up more resources, because the IRS does a very real cost benefit analysis. It costs them a certain amount of money to do an audit, and they have to expect that they're going to make at least that much back. So if somebody's claiming a kid that isn't theirs, no problem, easy win. You'll get $5,000 out of back from the taxpayer, and it costs a small amount, $1,000, $2,000. So that's profitable for the IRS, audit departments, because they have to justify their jobs like anybody else. So the way to not be a target is to not be a target. Basically, you don't want to do these things that they know they can just send a letter with a correspondence audit, which most audits are, and then you're unable to come up with the response, and then they just charge you. So you want to be that professional. You want to have that level of sophistication inside of the tax returns themselves, in order to show that the IRS that you actually know what it is that you're doing. So that I believe, bottom line, taxes suck, and they're confusing. So millions of people are going to be confused by the home office deduction this upcoming year, and I think the IRS is just going to be mass mailing those letters saying, hey, we are examining your return, which is their code word for audit, and we need you to prove that you are doing things in the allowable way. And they're all missing that. So, what else are they missing? It could be all kinds of things. So what we do at Tax Sherpa is, we have a 47-point, what we call the DCS diagnostic. You can go through it. It's taxsherpa.co, not com, just co/real-estate. And that's completely free, no obligation. What we do is, we look at your returns and we identify the areas that are at risk, and we can go through and say, well, this is a problem, this is an issue, this looks good, and here's what we recommend. And you can take that with you and go somewhere else and do it, or we can do it. We can continue to work together. That's kind of our deal. It's always about leading with value. So those three things, I think, are the biggest three things that are going to be facing real estate professionals, agents, investors, flippers, everything in the coming tax year. So then, like I said, I left plenty of time. I think we still got about 30 minutes for questions, because anytime I talk, everybody has their own question, because everything is individualized when it comes to taxes.
Yeah.
But the answer is always, it depends.
We do have some questions. I don't Neal, can you see the chat box?
I cannot. Let me see. It might be hidden by the screen.
Let me do this. Hang on one second. I'm going to repost Tom Silvestri's question, and then I'll repost Susan Murray's question.
All right.
So let me know if
Let me just exit this. No, that didn't do it. Oh, it was about to pop up, but all right.
if you can, I can always just read these out. But I'm reposting their questions now.
All right. So what tax planning do you recommend for the Biden administration? Specifically, is taxation plans to alter / eliminate 1031 exchanges, eliminate step-up basis, increase long-term capital gains, etc.? So that is a big question, and that is one that we are facing, as we go. So what he's talking about there is that Biden has said a lot of things about what he plans to do when he comes into office, and a couple of those things are really, really pertinent for real estate investment specifically, so under current law, you have let's just start at the beginning. You have step up in basis. So that means you have usually a parent passes away and leaves a child a property. Under the way the rules work now, you inherit that property, and your basis in terms of how much it costs for you is whatever the market value is upon inheritance. And that's called the step up. So grandma bought a house for $5,000 in 1952. It's now worth $350,000. Passes away, leaves it to her son. The son gets it at the $350,000 value. So turns around and sells it, very quickly. $350 purchase, $350 sale, zero capital gains. But what Biden's proposing is to eliminate the step up in basis, so that if grandma paid $5,000 all those years ago, and son inherits, and then sells, the son is paying tax from $5,000 to $350,000. So that is a huge difference, and that the generational transfer will be severely impacted by that. Eliminating 1031 exchanges. I'm sure you guys all know 1031 is the like kind exchange, where you can keep rolling gains into real estate. Used to be other things, but Tax Cut and Jobs Act limited that to just real estate. And so you can flip, roll, flip, roll, flip, roll, and then die, basically, and then leave the appreciated assets to your heirs, and they get it effectively tax free, as long as you're below the estate limits. And then capital gains. So under current law, capital gains, which long-term capital gains, which is held for at least 1 year, is that you can either pay 0% capital gains tax, 15%, or 20%, depending on how much total income you have that year. If you're a high enough income, you also pay an additional 3.8% in Obamacare taxes. So what they are saying now is that if you make more than $1 million, they're gonna get rid of the preferential capital gains treatment, and it'll just be taxed at your ordinary rates. And they want to raise those too. So from 37 to 39.6. So, I mean, all across the board, that is negative for real estate investors. As far as, tax planning for that. So one thing is that we have to some degree, we have to wait and see kind of what they do. So they need Congress to actually pass the law that Biden could then sign. It's looking like, at least for this session, Senate will still be Republican. So I don't anticipate too much happening if that holds. If Democrats get the House and the Senate and the presidency, then they have a very good shot of running all these through, and that'll be, in 2021, typically for the 2022 tax year. They might be able to get it in same year, but less likely. So as far as planning for all that goes, it's like, well, it depends a lot on the specific language that they pass, as far as income thresholds and all those kinds of things. If it ends up being $1 million issue, $1 million income issue, then you want to plan things such that your income is below those thresholds. If they end up doing no thresholds, well, then we have to look at other things like the charitable remainder trusts and the family endowment plans and those kinds of things, where you can sell assets but then not personally take the gains and do things like that. But it's going to be it's a very much case by case basis, and it's going to depend a lot on what it is that they actually pass, if anything. All right, so I hope that that helped answer some of those. That's actually a very deep question.
I think we need some clarification on the quote unquote. So we're allowed to have a regular home office, meaning we can state where and when we work in a certain room and count it.
Yeah, I mean, it doesn't have to be a whole room. It can be any square footage in your house. That's all fine. It's and then, like I said, the two requirements are that it's regular and that it's periodic, and it's exclusive. So you only do that. So like for me, the way I define my home office is so I have my desk. I have a little L-shaped desk. I've got my filing cabinet right here, and my computer screen. Behind that is a wall, and back here is right there is my green screen. So that total area is about 5 feet by 4 feet, and I can justifiably defend that as exclusively for home office. I'm in my basement. The actual room is much larger. It's probably, I don't know, 800 square feet, something like that. But there's other stuff. I've got boxes, and I've got an old dresser, and I've got my kids scooters and stuff are behind the green screen. So that all stuff does not count for my home office. So that if I were to ever get audited on that, then I can point to this and say, yes, this space is regular. I use it every day. I'm a bit of a workaholic, so really every day, and it is exclusive for business, because that's all I do here. And when I'm doing other stuff, I'm somewhere else. So you can do it. It can be any square footage in your house. You just have to be able to defend that usage. Yeah.
So can you talk, Neal? So someone's got a 4-bedroom house and they take 1 bedroom and they're using that exclusively for their home office. The recommendation then would be to don't have a trundle bed in there for when you have a guest over, because then that's not going to be exclusive. But if you just have, so in my case, my garage is converted, and approximately 250 square feet of the 400 square feet is exclusive to my office. There's nothing in here that's not office.
Right.
So that's defendable space, because on the other side of this wall, there's some storage and a pass through and that sort of thing. So we're not counting that, but this in here is just home office.
Yes, exactly. And one thing to keep in mind is that a home office is actually harder than a regular office. So if you go to a regular office and you meet Joe there and you have lunch at your desk or whatever, that's still fine. It's still an office. It's still deductible. But it's only when you get to the home office that you have this exclusivity part. There was another case, which is horrible. A woman had a crib in her home office because she had a baby, right? Babies has to be there. Mom needs to be near the baby. And they went ahead and they said, well, that's not exclusively business. But if you had an outside the house office, brought in a crib, that would be perfectly okay. So it's much stricter on the home office than it is on regular commercial real estate office.
And I remember sometime, I can't remember who it was, with some mastermind session we were in, we were talking about commuting to home offices. And I think you actually had described like how to do a commute in your house to start your day or something
Yep,
like
yep.
that.
Yeah, from the coffee machine over to your desk, that's your commute.
Right.
In the pre-COVID times, one of the common things was you would rent a PO box or UPS box or whatever, and that would be your official address, so that you go from home to the post office box,
Yep.
check your mail. Now that is your commute, and then anything after that is now business mileage. And then on the way home, you come back to the post office box, check your mail, and then come home. So that is a potential strategy. Obviously, it's a lot less of a necessary thing, in COVID times, because so few. Well, mail isn't really that common anymore, but also just because everybody's at home now.
So what about, so I get up in the morning, I have my coffee, I come in here to my home office, I'm checking my email and stuff, and now I'm going to go visit a client. I'm going to go tour property, all that. I've started my day at my home office.
Yep.
Right. And so anything from that point on is going to be deductible mileage.
Yep.
And I think the thing was, but if you said, I think if I remember correctly, you said, but if you grab your cup of coffee and you went out the front door.
That's right.
And then went to like your other office, which we don't have at EXP, but when I was with Keller Williams, we did, that portion of the commute wouldn't be deductible.
Right.
It depends.
It depends. It's a crazy requirement, but that's the way the code is written, and that's the way they enforce it.
There's a couple other questions. Another follow-up from Susan. She's asking also, can you say what short-term capital gains is under the current code, i.e. for flippers, how much is it prior to 1 year? Is it taxed at owner's basic income rate?
Yeah.
I know that it's changed over the years too. I mean, several years ago it was very favorable. I mean, I think it was the Bush years that made it very favorable, but I don't know if it's been reversed. I've lost track of all that stuff,
Yeah. So under the current rules, short-term capital gains is any asset sale bought and sold within 365 days. So if you buy it today and sell it tomorrow, short-term. If you buy it today, today is November 16th, you sold it November 15th of next year, short-term capital gains. So that gets taxed at your ordinary income rates. So if you are a 22% bracket, then you're paying 22% on it. If you're a 35% bracket, you're paying 35% on it. And the thing that gets people on that is that they say, well, a lot of people have like a steady year-to-year income, whether it's job or self-employed or whatever it is. They say, okay, I make whatever, pick a number, $120,000 a year. And so that's my mental rate. But then they have this sale, they get a great flip, the market's rising like we've seen in the past, 6-8 months, and they just hit it just right. And now instead of 120,000, they're at, 450,000 for the year. So now all of their income, that whole thing, short-term capital gains plus their normal income of the 120, that all gets pushed into those higher brackets. So the tax hit can be much higher than people expect, because they're used to a certain kind of level. But that bracket creep can really get you. But it's just regular, whatever your ordinary rate is. And if you're a C corporation, which is unlikely, but if you are, there actually is no preference. It's under current law, it's flat 21%, short-term, long-term, ordinary, all the same.
Okay.
Currently, Neal, can you do a 1031 exchange with flips?
Yeah.
As long as you'd identified the next property, you're just required to do it within that time frame.
Yeah. And one thing to talk about 1031s is that I'm sure you guys know as real estate professionals, but you have to set it up in advance of the sale. So I have so many people coming to me is like, well, I sold this house, but then I bought another one. So that's fine, right? It's like, no, you gotta do the steps. You gotta have the 1031 intermediary. You can't take the money. And you have to, roll it over and follow all the rules and everything. So just keep that in mind. Before the sale, you have to set up your 1031.
It has to be identified on the sales agreements too,
Yeah.
It has to be written. So, hey, so Helen has a question, Helen Lukash. Hey, Helen, good to see you. What if going to the company office is voluntary? In most cases in real estate, it's not, they can't make us go to an office because we're independent contractors. And there's not a commute per se. If you're using a conference room to meet a client there, that mileage to get there would be allowed. But I think, like you said earlier, in the old days, you had to, if you go to a PO box, you do that first, and then all the mileage after that is what you start counting, which was what I did for years.
Yep.
It was easy because I had a bunch of properties, and that was easy for me. But what's the current status on that?
Yeah, if it's I'm getting an echo a little bit. If it's just I left home and I went to the office, then you're not going to be able to defend that as business mileage, because wherever you, even if it's a different place every day, you're still making a commute. So that's going to be, non-deductible, and then anything after that will be.
Okay.
So the workaround would be go to your home office, check your email, which starts your day,
Right.
then go to your office meeting at the office.
Exactly.
Of course, most realtors, as they're waking up in the morning, they're whipping out their cell phones, rubbing the dust from their eyes and looking at the emails. So, okay. Tom Silvestri is asking what cell phone deduction. In other words, a perfect example. My plan, international calling, all the bells and whistles, maximum, unlimited data storage, and all that stuff. But in reality, most of it is for business. But is it legitimate to separate out personal use on the same cell phone and deduct only that which is used for business, as long as you can defend it?
Yeah, if you can defend it, absolutely. You could, depending on how you're set up, whether you're Schedule C or if you're an S Corp or a partnership or something, you can also write up your own shareholder agreements where you like your cell phone is just provided by the company as a necessary expense for doing business, and if you have the paperwork there, then you can just deduct the whole thing. Otherwise, your fallback is to identify, it's like, okay, my bill is, for a family plan, it could be $250 a month, and 67% of it is for business because of XYZ, and then I deduct 67% of it.
Okay. And here's another one from Helen. It's going back to the home office deduction. Actually, you may want to, can you see that, Neil?
Yeah, it says, aren't supposed to be doing anything else in the square footage. Thought that if you don't count the area in the room other than where you are exclusively doing your work, you don't have a problem. You could deduct a percentage of the room that is exclusively dedicated to your work. Are you saying that this has changed? No, I'm not saying that has changed. That is correct. So just like my basement here is 800 square feet, 20 of it is home office. That is fine, as long as that's a real as long as it's a real number. But just what people tend to do is, it's a 10 by 12 room. I'm deducting 120 square feet, and that's it. And that's what opens that opportunity for the IRS to come in and say, well, you have a bed in there, or you have a couch in there, or whatever. So yes, if you are rigorous about the exact definition of the area that is your home office, then you're fine. You still might get audited, but you can at least defend it.
Yeah. Okay, and then Susan Murray from, oh, sorry, Deborah, go ahead.
I was gonna say, so be like, what was it, Herb in WKRP in Cincinnati? You need to put the tape on the floor.
Yeah. So that'll work.
So Susan Murray from beautiful Lynchburg, Virginia is asking, what is the best corporation type for realtors? And should a flipper do a C Corp for just flips and have regular income be taxed separately?
So this is my favorite kind of question, because the answer is, it depends. So yeah, best corporation type for realtors. Well, I would say standard is LLC. LLC is limited liability company. So under IRS definitions, LLCs don't actually exist because they are what they call creatures of the states. So every state has their own thing. Like in Delaware, you can be a series LLC. That doesn't exist pretty much anywhere else. But when you have an LLC, you have less filing requirements. You don't have to have minutes. You don't have to have meetings and all that kind of stuff. You can play around with your percentages if you have partners very easily. But then you have to tell the IRS how you want to be treated for tax purposes. LLC could be disregarded, could be just a Schedule C, it could be an S Corp, it could be a C Corp, it could be a partnership. So you have maximum flexibility with the LLCs. I do know that some of my clients in different states, their broker has different requirements of them as agents, whether that's depending on state law or whether that's depending on just their personal preference can vary. So some brokers require a PA, some require an LLC, some don't care, most don't care, but so always check. So as far as entity type, LLC is just kind of the standard, and nowadays there's just so many millions of them, since the 90s basically. As far as tax treatment, whether you want to be C Corp or S Corp or whatever, it really depends. It depends on what you're doing with the money. It depends on how much money you're making. It depends on if you're married or if you have kids. So just as an example, let's say you're making, let's say you're married, you got a couple kids, and spouse works a day job, W-2, makes $60,000 a year. You as a real estate agent and investor, you're bringing in, let's go with 120 again. So total household income is at 180. At that point, you're still better off being an S Corp, most likely. And that's simply because when you have an S Corp, or sometimes a partnership, but usually an S Corp, it's a flow through entity. So what that means is that the business files its own tax return. It has income of whatever, it has expenses of whatever, and you can do various tax strategies with that. But then that final number, the net profit at the bottom of the return, that comes into your personal tax return. So then you'll have W-2 income, if you have interest in dividends or whatever, and then you'll have that net profit number coming in, either adding or subtracting from the other numbers. So when you do that, and then you take, your most likely standard deduction, you take your qualified business income deduction, then you're left with your taxable income. Now that taxable income on the personal level is a graduated rate. It goes, 0, 10, 12, 20, 22, and on up from there. So you have to compare that blended rate up with a C Corp, which is a flat 21%. Most of the time, that blended rate is going to be lower than 21%. If you get up into the high numbers, so I've got one client right now who's, COVID's been good for their business. They went from $3 million revenue 2019 up to $14 million of revenue 2020. So they are in that very high bracket. And so they are better off filing as a C Corp because that 21% is less than the 37% on the personal side. Yeah. But then you have to consider also, what are you doing with the money? So the flat 21% can be really attractive in some cases. But then if you take that money out, you're paying yourself a dividend, and then you're paying 15% on top of that. And so now it's 21% plus 15%. So you're up to 36%. And that's really close to that 37% top rate. And that's intentional. So that comes from the Tax Cut and Jobs Act, where it used to be, you'd be paying 35% on corporate and 15% and be 50%. And that's what they called the double taxation, which I'm sure you've probably heard at some point or another. That's what they were referring to. So that has been reduced so that if you have high income, double taxation versus just high income, it comes out to be almost the same. But then if you're planning to reinvest, then a C Corp becomes much more attractive because you have the 21%, which can be lower than that blended rate if you're making a lot, and you're not taking the money out, you're just growing, and eventually you have some kind of exit plan in mind, and there are various strategies for that. And you can really reduce your overall tax burden that way. So it depends.
Yeah. Well, I will tell, and Susan, I will tell you, for everybody, what I did, partly because I wanted to have separation of liability. So for all my rental properties, whenever I got to $1 million in holdings, I would set up the next LLC.
Yep.
Right. So I never had more than so many eggs in one basket. For the businesses, generally they were service-based, brokerage company, title company, appraisal company, property management company. I set those all up as S Corps. And then for my flipping, I had a whole separate LLC just for flipping, because that was all, short-term, basically tax on my regular income rate. But we wanted to keep that separate from the rentals, because I did different things with rentals.
Yeah.
But at the end of the day, everything started off, it was an LLC, but for tax purposes, I categorize them as different entities based on what type of business it was. And in any case, I've only been audited once, guys, over all those years. I mean, we're talking 36 years this January in real estate, investing in a brokerage, only get audited. I've had, like you said before, Neal, paper audits. They're basically a letter, can you explain this? Or can you provide more documentation? One time I got the entire return completely audited. I mean, they come to visit me and everything.
That's
But I never got nervous, because we didn't take a lot of chances. I never did the office write-off, even though I had an actual real office in my home, the separate entrance and everything. It just wasn't worth the effort to do that for a few pennies. Just wasn't worth the risk of an audit. So I finally got audited. It was one of those level 8 GH that did the audit. And my return, just the basic IRS return, not including all the state returns, just the IRS, was 127 pages.
That's a lot.
And it took her a year. At the end of the year, she finally wrote and said, I forget the term, no net change. The return was no change to the return.
Yeah.
So
yeah, they have the IRS has a real problem with auditors being what's the nice way to say it? Lacking experience. Let's go with that. So they got their budgets cut in 2014, 2015, something like that.
Yeah.
There was there was a whole big thing about them specifically targeting Republicans and that kind of thing.
Yeah.
So they've had their budget cut, and they've been suffering ever since. In that they can't hire as many people, they can't train as many people. There was also a thing where they went to Hawaii and had a corporate thing and recorded like crazy videos of themselves at these resorts, and Congress was like, you know what, we're not going to fund you. So yeah, I mean, you have these people, and they are lacking experience, they're lacking sophistication, because those people who have that sophistication can get better jobs than working for the IRS.
Right.
So by presenting yourself as one of those more difficult targets, by having the corporate structurings, set up and the 127-page return, you are preemptively defending yourself in that you're telling the IRS it's going to be expensive if you come after me. So,
hey, a couple of things, if you wouldn't mind, if we got a few minutes left. You brought up Series Llc earlier, and that's something that's relatively new in the world of LLCs. Would you mind explaining what that is? That's the first question. The second question is, we have a special project in our group right now. We just implemented and rolled out a network of investor groups around the country. We have 32 investor groups within our network, and everybody's having their first sessions this week. So congratulations, everybody. But one of the part of the culture, Neal, is that, and part of the agreement is that when they're in profit mode, it may be a year, maybe 2 years, I don't know, that each location is going to be responsible for buying a house we call a healing house. We're going to I think it's 501(c) nonprofit, where we provide a house to a local community for service to the community through, like, Alcoholics Anonymous, or homeless, elderly, whatever the greatest need is. The individual owner of that investor group, can determine how that house is used. But what I want to do is, I'm going to participate in those personally through the profits of the network, and I want to have it done such that the group maintains ownership of the property, and whatever, 10 years down the road, 30 years down the road, whatever, if the group owner decides to retire, that house will revert back to the ownership of the group. I don't know if I'm making sense, but would that fall under the category of like a charitable remainder trust, or do you have a recommendation for how we can do that so that we maintain ownership of the property, but the property is made available to the local community through some type of charitable service? But then they take all expenses. So like almost like a triple net lease, where we, the owners, have no expense. They take whoever leases are from us for service has all the expense. I'm starting to go down a rabbit hole, but I want to kind of give you that picture and see if you had a recommendation or a broad brushstroke for what we might pursue with that, and we'll probably hire you as our tax accountant.
Yeah. So, well, first question, what is a Series LLC? Is in certain states, and I know Delaware is one. I think another one just added them. I'd have to check though.
I think,
But
I think Wyoming does it too.
Okay, great. Yeah, Wyoming's become the hotspot for LLCs because Nevada got greedy with all the people coming to them, and they said, "Oh, we're going to jack up our rates." But so Series LLC is basically you form one LLC, but then it can be subdivided into subsidiaries with very, very little work. It's really attractive in like if you have that $1 million LLC holding rentals and you want to have a different one inside holding each property. So it's really attractive for that kind of setup. The issue with that when it comes to tax filings is that what some people want to do is they want to treat them all differently for tax purposes. So, okay, this part of my series is doing, flips, and this part of my series is doing rentals, and this part of my series is doing whatever. And the IRS has ruled that only can happen if they are completely separate entities. So basically, removing all the benefits of a Series LLC. So if you want to do it that way, then you end up having to have separate bank accounts and separate separate ownership, operating agreements. That's the word I was looking for, and separate EINs and separate everything's. So basically at that point you just have a bunch of companies. But if you're doing one activity and it's just seriesed for liability protection, then that's really attractive. But that only works if you're in one of those series states. So because if you have a series in Delaware and then you're buying properties in Georgia, then you have to register as a foreign entity operating in Georgia, and Georgia doesn't recognize the series, and then it just falls apart. So it's a very niche kind of thing. But if you're in one of those states and you're doing rentals, then great, do that. As far as the other scenario where you're talking about having a house and then renting it out. So a lot of times, I was in South Florida for years and years. We have many clients who run halfway houses for drug and alcohol addiction. So the way they operate is that one entity owns the properties and another entity operates the property. So that operating entity is dealing with the insurance companies, getting payment. They're dealing with, personnel issues. They're dealing with repair. So it really does become a triple net lease, where the operating company takes care of all the utilities and the taxes and everything, and just is paying a gross rent to the owner, and that has worked relatively well. And at that point, so if you have that individual who owns it originally, and then after retirement, it's transferring ownership over to either another group or whatever, then that's just a sale. It could be an off-market sale, but you're still going to have that same kind of tax treatment, depending on how that entity is set up and whether it's being 1031 or whatever it is. So that would be my first reaction for. Okay. What you described there.
Okay, appreciate that. Hey guys, any other questions? Melanie, David, Susan, let's see who we Augustin, Alyssa, Beverly, Ebony, trying to think of who else actually got something going on. Gary, Doyle, Helen, Jamila.
I will post, if you have other questions, just go to that site, taxsherpa.co/real-estate. And you can book a call. Intro consults are free, and we'll talk about your individual situation. So
okay,
that's kind of.
Well, I'll tell you what. Yeah, I appreciate you taking the time to do this. And I know you're a busy guy, and that's this is a real special treat for us. And thanks, David, for bringing Neal on. This is being recorded, so people will be able to. And we'll have. What we'll do is. We'll make sure we send you a recording of this too, Neal.
Oh, that'd be great. Thanks.
Yep.
People my whole life have told me I talk too fast, but we get a lot in that way.
That's okay. What I'll do too is we relaunched our podcast just literally the last few weeks, rebranded it and everything.
Great.
So I'll have you on that too, and that'll go out to all the investors. We got several thousand around the country, so
that'd be fantastic.
Neil,
Yeah.
what's that URL again?
It's taxsherpa.co, which is that right there.
Yeah.
And, / real-estate.
Real-estate. Okay.
Yeah. So that's that has a little questionnaire, leading into the booking, and asks you how many years you've been in business, and how many houses you're doing, that kind of stuff. So it's specifically tailored for real estate people.
Okay. All right. Well, everybody listen, I look forward to your upcoming first official gig sessions this week, Global Investor Groups. I'm going to try to log in as many as I can over the next 3 nights. And then there is no meeting next week, no regular weekly meeting, no GIA team meeting. The next meeting is the GIA team meeting on Monday, November 30th. And I think that is all we're doing for that week, if I'm not mistaken. Yeah. And the next regular weekly webinar, actually, maybe I'm wrong there. December. Oh, we'll be the very next night, Tuesday, December 1st. Sorry, the regular weekly webinar. Yeah. But in the meantime, you guys take care of yourselves. If I don't talk to you before Thanksgiving, have a happy, wonderful Thanksgiving with you and your family. Let's see. Oh, Neil, Sean Ritchie saying, thanks, David. Thanks, Neil. Thanks, Gary. Great stuff. Have a great night. Heading over to Mo's gig meetup. Oh, that's right. Hey, everybody. Mo and Oksana are doing their meetup right now from beautiful St. Louis, Missouri. So maybe tap into that and give them some love. So, all right, guys, have a wonderful night. Great rest of the week. Stay safe, stay healthy and wealthy and wise, and God bless you and your families. Okay.
Thanks so much. Thanks, Neil.
Okay, let's see.